Hi, and welcome back to the second part of our short video on shareholders' equity. So maybe you got a chance to go look at a Shark Tank video. I recommend that, or go out and look at the price of Microsoft and validate that yes, it was a very good investment back in the 80s. So we're talking about taking companies through this process in their equity financing journey to the initial public offering, and that's what we're going to spend more of our time. This is when a company is trying to generate a lot of capital from the marketplace, tens, hundreds of millions of dollars. And they're going to go sell their shares to the investing public, which means they have to do a lot of filing with the Securities and Exchange Commission in accordance with GAAP. One of the first things they're going to do is they need to have an article, they need to file articles of incorporation or their corporate charter to talk about what is the company, what are they selling, what's their financial backing, what are some of the risks, what do they expect their finances to be going forward in time. As part of those articles of incorporation, they need to identify how many shares of stock are there going to be available in this company. So this is this first term, authorized shares, the number of shares that are authorized for this particular company. And we want this number to be pretty big because once we've done all this paperwork, we don't want to go back and redo it to issue more shares. We want to have this maybe be like a million shares. And we're expecting to issue maybe 100,000 shares or maybe 200,000 shares. And we'd like to have some in reserve that we could issue later in the company's life when we decide that maybe we need more capital. So authorized stock, this is going to be a pretty big number. A lot of our stock will remain unissued until later in the company's lifespan. And then of the issued stock that is sold in the marketplace, there's two possibilities for those shares. One is that the investors are still holding those shares, and that's called outstanding stock. And this is kind of what we've been referring to in class all along, this common stock here. This is the outstanding stock. Another choice for issued stock is that we have issued it, we sold it in the marketplace, and then we repurchased it. We bought it back, and that's going to be treasury stock. Just as a side note, a lot of companies are incorporated in the state of Delaware, just like trivia here, because they have such favorable incorporation laws for corporations. So just a reminder here, authorized, those are the shares that are available to sell over the life of the company, unless we do a whole bunch more paperwork, then we can up it. But otherwise, the shares available to sell, those are issued and unissued shares. What's issued is the shares that we actually sold, and that includes outstanding shares and treasury shares, which we'll talk more about. And then outstanding shares are just the ones that have been issued and held by the investors. And then treasury shares have been issued, and then we've repurchased them. We'll talk about why we might want to do that. Okay, here's another term that we have to talk about. And in accounting, we don't love this term, but we have to deal with it. It's called par value. So some shares of stock, some common and preferred shares have this funny little nomenclature, this funny little term called par value. Now, stocks can be issued with a par value, or they can be issued as no par. Now, we prefer stocks that are issued at no par. But let's talk about what this par value is. It doesn't really have meaning in today's economy. Par value had a historical basis. It was really the legal documentation, back in the industrial age that said, this piece of paper that represents a part of the company is no less than X amount of dollars. And it was really based on how much equipment, like the steel mill, had. And if I was going to sell 100 shares of stock, then it would be, 1/100th of the value of the steel equipment. That would be what par value is. Obviously, when you're talking about like Google or Apple, like there's no steel mill there. There's nothing to really base this on. So some states allow companies to have no par stock. That's easier. Others, they have to have some par value. A lot of times companies will have a par value of like a cent. It has no relationship to the market value of the common stock. So let's go out and take a look. I'm just going to go out. Let's just take the look at Home Depot. So I'm going to go out to, not that one. I'm going to go out to the Home Depot. Here I am at Home Depot. I'm looking at their balance sheet. So we've done the asset part, the liabilities and the liabilities part, and now we're looking at the common stock, the shareholders' equity side of this. It tells us that Home Depot has common stock that has a par value of a nickel. Par value of a nickel. Here's their authorized shares, and these are probably in thousands or millions, so 10 million shares, and we have issued 1.7 million shares. There are 1.077 of those shares outstanding. So some of them are treasury shares, some of them are outstanding here. It's about 700,000 shares that are treasury stock, right? This has been issued, and then here's what's still outstanding. All right, so look at this value over here. This $89 million, this is based on the number of shares that were issued times the par value. Right? When we issue shares, we issue them at a price that's based on the market. So I'm making up the issue price for Home Depot. Let's assume that when I took it, when we did the IPO, the stock was issued at $10 a share. This par value has no meaning, right? It's just like, well, $9.95 was paid in capital or additional paid in capital, and a nickel was based on this par value. So to understand how much our investors have given us, we need to add these two numbers together. It's annoying, but that's the way it is. So now you, having sat in this class, know that when you're looking at the statement of shareholders' equity, that you have to add the par value and the paid in capital together to know how much those shares were issued to the market for, and that our investors paid in to own shares of our stock. There's that retained earnings. That one's not a surprise here. The comprehensive loss we don't deal with in this class, but you will in your intermediate accounting classes. And here's this treasury stock. Treasury stock is a contra shareholders equity account. The investors gave us money, and then we bought stock back from them and gave them money. Cool, huh? All right, we'll talk more about it, I promise. All right, so we looked a little bit at the balance sheet there. So let's go ahead and account for the common stock. So here's Canadian Falcon. We're going to make two different assumptions about it. One is that they have no par stock. That's the one we prefer. Or the second assumption, different assumption, they were incorporated in a different state and they had to have a par value. If they issue 1,000 shares of no par common stock at $30 a share, this will look like every piece of work we've done so far. So here's the cash. They got $30,000 and they issued common stock for $30,000. Yay, ta-da. For par value stock, we still get $30,000 of cash, but we're going to account for it in these two categories. The common stock is the shares, the number of shares times the par value. There's 1,000 shares at 1 cent, this weird par value. So there's $10. That's the common stock account. Here is the paid in capital, the additional paid in capital, $29,990. There's not a difference in the overall result of what we've done. It's just the way we've categorized it from an accounting standpoint. So let's look at this example. Company A, they've issued 20,000 shares at $5 par, and they've issued, the issue price is $12.50. So what would be the entry to record the issues? It would include which of the following? Debit to cash of 100,000. Now, when we take the 20,000 shares and we issue it at $12.50, we're going to get more cash than $100,000. A credit to common stock of $250? No. Here's the 20,000 shares. There's the par value. The common stock is going to have a credit to common stock of $100,000. Here's the additional paid in capital. Here's the additional paid in capital. The $12.50 minus the 5, that's an additional $7.50 times the 20,000 shares. That's going to be the journal entry that we need to note. We're going to practice this. Last concept that I want to talk about for a moment is something called preferred shares. So we've been talking about common stock. Companies can also issue preferred shares, and preferred shares are only preferred with regards to dividends. Usually they don't have any voting rights, but they do get preference with respect to dividends. If I am a company and I'm going to pay dividends, I have to pay my preferred shareholders first. Often those dividends are cumulative. So if I didn't pay my preferred shareholders dividends in the prior year, I have to make up those dividends from the prior year, then pay my preferred shareholders dividends for this year, and then I can pay the common shareholders some dividends. So they're preferred with respect to dividends. Conceptually, preferred stock is somewhere between a bond and a common stock, right? They don't get voting rights. They're a little bit less risky than common stock. They're a little higher in the hierarchy. If the company goes bankrupt, they often get they have preferred in terms of getting money from the company. So common stock has voting rights. Preferred usually no. Bonds definitely not. Highest, middle, lowest, right? You can look through this table on your own. Tax deductibility, no, usually no, and bonds, yes, right? Let's do the accounting for the preferred stock. Is just the same as it was for the common stock. Here's 1,000 shares of $30 par value preferred stock, and we're issuing it at $40. So when we issue it at $40, we're going to get $40,000 of cash. The preferred stock would be the 1,000 times the par value, and the additional paid in capital is the market value above the par value. So when I look at the shareholder section for Canadian Falcon in total, here's my preferred stock, $30 par value, there it is. Here's my common stock, 1 cent par value, there it is. And the additional paid in capital, this is for the common stock and for the preferred shares. So the total paid in capital, this is how much our investors have given us, $70,000. The retained earnings is 30, and the total stockholders' equity is 100. And then we'll pick it up on Wednesday with our discussion on dividends. Talk to you then.